My Lords, my remarks relate to Clause 1 of the bill, and I should preface them by saying that I've benefited from briefings from certain firms of city stockbrokers. This is obviously a regrettable but necessary bill, which of course one supports, and at times like this, one casts around looking for people to blame for getting us into this situation. It could be the avarice of the promoters, the weakness of the regulators, or the cupidity of the private investors. And it is the last that I wish to focus my remarks on, because I think it would be a great mistake if we were to conclude from this that private investors can't be trusted to know where to put their money and that they should be further protected and restricted in the opportunities available to them. Just to take one example, over the last 12 months, literally billions of pounds have gone into premium bonds and national saving products, showing that private investors, retail investors, can make very sensible and do make very sensible choices, some totally dwarfing what was invested in London capital and finance. But it's not surprising that private investors do end up, some of them, investing in dodgy mini-bonds when we have removed from them the opportunity to make respectable investments. I'm not just talking here, when I refer to private investors, about comfortable rentiers. I'm talking about perfectly ordinary people, some of them called SID. What has happened in the last 10 or 20 years to the opportunities available to them for investment in respectable securities? If we take equities, it is true that they can invest in the secondary market, but the new issues of equity securities, which it was possible for them to invest in, have dried up almost completely. The IPOs no longer reach the public markets. They are all now private placements because it suits finance directors to cut the private investor out, and the regulators are compliant in that. No more SIDS. Well, what then about government bonds, about gilts? These used to be available for purchase at the post office, and if you wanted to invest in a new issue of gilts, you could literally cut a coupon out of a newspaper and send it in, making a non-competitive bid. This hardly happens anymore. Take, for an example, the government's recent green gilt. This was not marketed at private investors at all. Instead, private investors are going to be offered an opportunity in due course to invest in what is called the green bond. But if you look at it, this isn't a bond at all. It's another national savings fixed-term deposit product. Now, the Debt Management Office says, why should we reach out to private investors beyond what we do? Because we get all the money we want from them through the existing national insurance products. But I think that is the attitude of the bean counter, not of the nation builder. If we come finally then to corporate bonds, highly rated bonds issued by large companies, the effect of European Union regulation, and particularly the Prospectus Directive, which is still in force, is that bonds denominated with a denomination less than €100,000 require much more elaborate regulation. Now, when I worked in bonds 30 or 40 years ago, the private investor was the backbone of the market. The denomination of most bonds was actually closer to $1,000 or £1,000 than 100,000. So they were available. You could invest in them. Now you need €100,000 just to buy one. Well, of course, private investors are effectively cut out of that market. And there are other reasons why these securities are no longer available. Now, this is not just about where people put their money. In my view, it is about the democratization of financial markets, or rather about their de-democratization over the last 10 or 15 years. It's also, to some extent, about levelling up. And it should be on the government's agenda that ordinary people have access to reputable financial investments in the way that large institutional investors do, and they no longer do. It's also about winning and maintaining popular support for the financial services markets, which are important to us and to our economy. But if they are more fragile if they are totally disconnected from ordinary investors. And it is, as I say, about giving investors an opportunity to avoid having to invest in alternative dodgy mini-bonds that then need, in some cases, to be rescued at the expense of the Treasury. It is a big subject. I don't expect a comprehensive answer from my noble friend this afternoon, but I do hope that he would be willing to meet with me and one or two city experts, and possibly even rope in the Economic Secretary to the Treasury, because this is, in my view, too important a subject for changes to be made through a whittling of regulation and other administrative changes, as we've seen over the last 15 years, without occasionally, as today perhaps, stopping to take stock of what those cumulative effects have been.